the second part of this series, which is the video you're watching right now, I will discuss the most common mistakes I see business owners make in their first few years in business. Let's jump straight in. Hello and welcome to the Savvy Corner, where we talk about personal and business finances, financial well-being and money mindset. As you can see from the title, this video is part 2 of a mini-series on money mistakes to avoid as a new business owner. Part 1 talked about the mistakes business owners make when they are just starting out. And if you haven't seen that video, I will link it for you on the screen and in the description box below. In the second part of this series, which is the video you're watching right now, I will discuss the most common mistakes I see business owners make in their first few years in business. Let's jump straight in. One of the first things I see people delegate in their business is the financial administration of it. Few people like to deal with their finances themselves or feel that they are capable to do it, so they outsource this activity to someone else. And that can be a good thing. As a business owner, there comes a time when you move on from doing it all yourself, and you pay people to do certain things for you so that you can focus on running the business, making decisions, bringing in more business, etc. However, in my opinion, it is a mistake to delegate your finances before you have enough understanding of them. Most, if not all, of the decisions that you make in your business will have a financial implication, whether it's a direct or an indirect one. At the very minimum, as a business owner, you need to understand basic financial concepts and their application in business. I'm talking about the concepts of assets, liabilities, return on investment, cash flow projections, taxation rules relevant to how you run your business, and also accounting concepts such as accounts payable, accounts receivable, payment terms, capital expenditure, depreciation, and so on. You can, of course, learn about these by reading some books, and there are plenty of books around, but in order for you to understand them in practice, you need to apply them to your own business and see how they affect it. Without a proper understanding of your finances, you will always have a blind spot in your decision making. If you're already in this situation, I'm not suggesting that you should now go and fire your accountant or your bookkeeper and start doing it all yourself. But work with them and ask them questions about the financial aspect of your business so that you can understand it better. Because making a decision without having a degree of financial literacy is like signing a contract without being able to read and understand what it is that you're signing. On the other side of the spectrum are those who choose to do their own finances. If you're in this category, I urge you to think long term. It might be that right now your business finances are not very complicated and you have enough time to do them yourself. However, there will come a time when you will most likely have to outsource this activity. And when that time comes, you want to make that transition as smooth as possible, both for you and for the person who is taking over. So the mistake to avoid here is not having a proper accounting or bookkeeping system. Yes, you can keep records in Excel and you can file your receipts in a Dropbox or a Google Drive folder. But bookkeeping is a lot more than just recording and filing receipts and issuing invoices. If you're going to go the DIY route, set yourself up for success by investing in an accounting or bookkeeping software. The next money mistake I want to talk about is not having enough cash deposits. Depending on your payment terms and your business model, you might only see revenue coming in for the sales you've made weeks or even months after the sale. Or your business might be seasonal, which means that it makes more money during the summer and less during the winter times, let's say. Having enough cash deposits means that you can still run the business and pay for your operating expenses during times of low cash inflows. It also means that if there is an emergency, you can cover some, if not all of the costs associated with it, and therefore minimize the overall financial impact the emergency will have on the day-to-day business operations. As a general rule of thumb, a cash deposit covering 3 to 6 months of your monthly operating expenses is a good figure to aim for. But of course, you know the practicalities and the risks associated with your business, so use your judgment here and consult with your accountant if you have one. I am interrupting this video to ask you, are you enjoying it so far? If you are, please give it a thumbs up and consider subscribing for similar content. Thank you in advance if you do. Now let's get back to those money mistakes. Another money mistake I see business owners make is not following up. What does that have to do with money, right? Well, quite a lot. As a business owner, you put in a lot of effort to bring in clients and to deliver the service or the product that you're offering. If you don't follow up on unpaid invoices, you risk selling your stuff for free. If you don't follow up on conversations you've had with prospects, you risk not closing the deal when in reality that person might have said yes if you got in touch. If you don't follow up on testimonials for the work that you've delivered, you will have less social proof to put in front of your audience and potential clients, regardless of how much your clients enjoy working with you and the results that you are helping them generate. All these situations I describe here have direct and indirect financial consequences. Like I said in the beginning of the video, every decision you make will have a financial impact. So decide that you will follow up. Why do people choose not to do it? For several reasons, I find. They forget, or they don't have a system in place that flags it up for them. They don't have time to do it. But more often than not, they think it's inappropriate to do so. They think along the lines of, oh, I don't want to insist. Maybe this person's struggling financially. I'm sure they will pay me when they can. Or, I asked them for a testimonial already. Perhaps they don't want to give me one and I don't want to force things. Or, this prospect said that they will come back to me, and since they haven't, that must mean that they're not interested in working together. All of these are assumptions. And based on these assumptions, we create all sorts of stories and ideas in our minds. When in fact, the reality can be that they forgot. They didn't have time to do it. Something urgent might have come up and it's still on their to-do list. The fact is that we will never know until we ask them. So put your fears of rejection and your assumptions aside and follow up. The next two mistakes I want to talk about go hand in hand. The first one is to not set clear financial goals for your business and adopt a business model that helps you reach those goals. If your goal is for your business to be successful, how do you define that? How will you measure this success? Will you look at revenue coming in, or will you look at profitability? You might be making more money, but if your costs grow disproportionately compared to your revenue, does that make your business more successful? By setting clear financial goals, I don't just mean thinking about the numbers. I want the business to generate this much revenue or this much profit. You can get more nuanced than that and actually think about setting growth goals or acquisition goals. Perhaps you want to buy a building or another company, or you want to hire your first employee, whatever it might be for your business. Having these goals as clear as possible allows you to then adopt a business model that facilitates reaching these goals. If you are a coach and your offering is one-to-one coaching sessions, for example, there is only so many sessions that you can do before you reach a ceiling that doesn't allow you to grow your business anymore, at least not without burning yourself out. It's really important to match your business model and your offering with your goals. Otherwise, you risk chasing some goals that with your current business model are simply not achievable. Another mistake related to the previous one I just mentioned is not setting appropriate prices and not charging in line with your financial goals. I see this a lot with business owners who operate in unregulated industries such as coaching. They simply don't know how to price their service or products because there's no guidance around it. You can have a great business plan and follow a good business model and still not meet your financial goals because of your pricing model or structure. Now, I cannot tell you how much to charge, but from my experience working with clients on pricing, it depends on a few things. The industry you're in, your geographical location, or the one of your clients if you're working online, their age group and level of disposable income, the type of service or product that you offer, the barriers to entry on that market, your costs, your opportunity costs, and I could go on and on and on. If you need help with this, please get in touch. Pricing and charging is something I focus a lot in my work with clients, so I might be able to help you if you're struggling in this area. I will leave the link to my diary in the description box below. If you've watched this far, you are a star and you have my respect, because if you had the patience to listen to all of these mistakes I mentioned, then I know you will have the drive and the discipline to avoid them. I hope you enjoyed the video. If you'd like to see more, I invite you to check out the two that are suggested on the screen right now. That's it from me for today. Thank you so much for watching. I'll see you in the next one. Bye!